What's up, everyone? This is Tasha, your realtor slash life insurance agent. I am back with the second video. This video, as I mentioned to you earlier, is about a 45-year-old male who wants to utilize the IUL for his savings. He is currently putting in $1,000 into his savings account, and he now wants to do away with the savings account and be able to save his monthly $1,000 into an IUL. So we're going to do a live illustration, and I like to do these case studies for my practice, because the more I practice on this, the better I will become at it as well, and the more you guys could see that I know what I'm doing. So we're gonna go ahead and get into it without further ado. This is going to be coming from National Life Group. I was hoping to have all of my appointments with Allianz completed, but it's still pending. And so because it's still pending, I'm not able to get into the website, which is fine because I have National Life Group. So let's go ahead and get started. So I'm going to share my screen. Okay, this is my back office with National Life Group. Let me make this screen full. Okay, so now what we're going to do is we're going to go to illustration. And we're going to go to new illustration. Okay. And what we're going to do, the product type is going to be Index Universal Life. We're going to click on Flex Life. Now, my client's name is John Doe. I don't like to use real names because, again, you know, this is just a case that I try to come up with to do on a daily basis. So, John Doe, he's a male, and he is 45. Okay. So we're going to go over here to death benefit and funding. Now, let me explain to you what it is that he wants to do. So from age 45 to age 65, he wants to pay in a monthly premium of $1,000. He wants to be paid up at age 65. Okay. Now, at age 66, he wants that lifetime income benefit, meaning that he wants that income coming in. So we're going to set it up to where at age 65, he's paid up, and then he's going to start receiving his lifetime income benefits. And you'll see it here on the illustration. So, and he's wanting to maximize his cash value as well. So what we're going to do is we're going to go here to minimum death benefit, max cash funding, and we're going to keep an eye over here on our summary values, okay? Because this is going to tell us whether or not we're making, or if we can actually, if the calculations are unavailable, as you see, or if, you know, it's lapsing. We don't want it to met, we don't want it to lapse, and we definitely want it to calculate. So we're going to go here to death benefit options. You have option A, where your premiums are leveled. Your face amount is leveled. I meant to say, it doesn't change. It just stays. If it's $100,000, it'll stay $100,000 throughout the whole time. Or we can go to option B, where your death benefit increases each year. So we're going to go to option B. Now, usually I like to put a lump sum in, but he don't want to do a dump. He's not going to dump. He's not going to dump his $3,000 in. He's just going to leave it as is, and he just want to start his monthly premiums at $1,000. So we're going to go here, monthly premium mode. That monthly premium mode is that $1,000 that will be coming in, that he'll be paying monthly. And so you take that $1,000, as you will see on the illustration, and you times that by 12, and that will give you $12,000 yearly that is actually going into his IUL. Okay, so now we're going to specify the amount. So now you see here, we want to pay attention to this and this. We want to make sure that this is saying NA, the MEC year, and we want to make sure that the lapse year is saying NA. So we're going to do $1,000. Okay, everything's still looking good here. And now from the from through button, we're going to do year 1, which is age 45 to age 65. He wants the premium to come out from he wants to make premiums from 45 to 65. Everything is still looking good over here, okay? Now we're going to scroll down, and he wants to be able to, at age 66, he's wanting to be able to start receiving this yearly income that's coming in. So he wants to be able to start seeing his yearly income that's coming in, okay? So we're going to go to lifetime income benefit. And so that's 22 years. Age 45 to 65 is 22. Let's make sure the math is correct. Subtract 65. Actually, it's 20. So, well, that's 20 years. So, well, it's going to start year 22. He'll start seeing it. Okay, so right now it looks like everything is good. Everything is good. We got the increase in term. We got the year 1 to age 65. We have lifetime income benefit. And then we have 22 through maturity. So now let's go to our writers. He already got his ABR, so we're just going to leave everything the same. The ABRs, is the terminal illness is included. The chronic illness is included, critical injury, and Alzheimer's disease. All of that is included, so we're just going to leave that alone. And then, let's see. We're going to do 50% here. And I cap S&P 500 point-to-point cap focus. And then our, I think it's 25. It's got to equal 100%. And then 25 here. No, that's not right. Hang on, something went wrong. Actually, let's do this. Let's see. Okay. Okay. So all we did was, it has a cap and it has a floor. So pretty much whatever the insurance cap is, where the carrier cap is, pretty much we're participating in the upside market. And if the cap is, if the insurance carrier cap is 12%, but the market jumps up 14%, then you're only going to get that that cap, that 12%. And if the floor is 0%, then your money is safe. You don't lose, but you don't gain or whatever. So it just depends on the carrier. Okay. So let's see here. Now let's go. We are in our quick view. Okay, so This is the minimum yearly that my client can pay in, $1,500. That's the minimum. Then you have yearly for the death benefit protections, the $1,800, and then you have your target premium, which is $3,000, and then you have your MEC, which is $14,000, and then you have your guideline level premium. So let's go over here and talk about this. So your target premium is $3,451. Your guideline level premium is $12,000. Guideline level single is $73,000. This $12,000 is the most that they can put in yearly, pretty much. That's what they can put in yearly. The guideline level premium cannot exceed the guideline level single. It can't do that. The non-MEC premium is, if anything is over this MEC number, then your policy is going to be a modified endowment. So the policy premiums cannot exceed the non-MEC or the MEC premium, if that makes sense. Everything looks good. Everything, there's no lapse, and we're not MECing. Everything looks great. So, age 45, we already have a accumulated value of $10,000, surrender value of $5,000. And then as you see, year 2, 3, 4, it keeps going. Premiums are $12,000 yearly. Now this is yearly. Planned premiums yearly. That's the $1,000 each month, which equals $12,000. So this is what he's paying in yearly up until age 65. Okay. At age 65, he already has a cash value of $424,000 at age 65. Okay, so now at age 66, year 22, that's where that 22 comes in at. Year 22, he is eligible for loans. You see that column, this is loans. And then he will, annual income, this is what he will receive yearly. $29,000 yearly. Annual income from age 66 to the day he decides that he wanted to check out. So this is a great savings vehicle for someone that actually don't want to utilize the bank to save their money, but utilize the life insurance IUL. So I encourage anyone that if you can, it don't even have to be this amount. It don't even have to be, you can start your IUL as low as $100. It's flexible. It's flexible. You have to make sure that, you know, it is to fit your budget. But I think this is a really good illustration. His face amount is $205,000 is what he will get. And in the event of any critical illnesses, all of those are included. And he could just borrow from the death benefit in the event, he can take from the death benefit in the event that something was to happen, if he was to get critically ill, if he was to get terminally ill or chronically ill, or get Alzheimer's. He can take a portion of his death benefit and do whatever he wants to do with it. That is your living benefits. So this is a great illustration, I think. Like I said, I do these case studies to help me to practice, you know, to help me get better and explaining it and showing you guys what it is that I do. But other than that, tomorrow, I want to thank you guys for watching me do John Doe's case. And he's very satisfied with this because he actually came out better with doing it this way versus saving his money in the bank. So this is really, really great. So tomorrow I will have another case study, but it will be on someone who wants to start out, but they don't want to start out with a high modal premium. I think she wants to start it out with like $50, and she's not really worried about the cash value right now, but in the future she will be. So we'll do a case study on that tomorrow. So I want to thank you guys for tuning in, and thank you for allowing me to share this with you guys. If you are interested in the IUL, please don't be alarmed. Please don't get discouraged because you see these high premiums. You know, a lot of people want to pay these high premiums because they want that cash value to build quickly. So so that's the reason that some do that, but you don't have to have a modal premium that high. It's whatever that can fit your budget. So again, I want to thank you guys for tuning in. Thank you for allowing me to be able to do my case study with you today, sorry. And tomorrow we will have another case study, and it will be on a lady who is 25, a young girl who's 25 who wants to start an IUL, but right now she just wants to start it with as low as $100. And hope you guys tune in. And if you have any questions, or if you're interested in maybe getting an IUL, feel free to message me on Facebook, Instagram, TikTok. You can email me at njfinalexpense1@gmail.com, or you can call me at 828-794-8111. Thank you guys for tuning in. Have a great day.